In December, monthly inflation in the U.S. was a bit higher than expected, reaching 0.5%, while the annual inflation increased to 7% and was the same as expected. According to the website Crypto News, economists expected that the Consumer Price Index, CPI, a key measure of consumer prices released by the U.S. Labor Department, will show that inflation jumped by 0.4% in December and 7% year-over-year, the highest increase in prices since 1982. Bitcoin moved up after the numbers were released, jumping from $43,400 to $43,900 in several minutes, and increasing its daily gains to around 5%. Ethereum also moved up, surpassing $3,375 and increasing daily gains to 8%. While economists disagree on when inflation will peak, it's well past the initial time frame the Federal Reserve had expected to see. You've got the Fed in panic instead of patient mode, so the risk is overshooting. We're now in a position of the Fed chasing instead of anticipating. It's worrisome, Diane Swank, chief economist at Grant Thornton, told CNBC. According to Marcus Soterio, an analyst at the UK-based digital asset broker Global Block, there may be a sell-off in the crypto market if the inflation numbers are larger than expected. This, however, shouldn't be a long event, as I suspect the market has already priced in the worst-case scenario due to the persistent selling recently, he wrote in an emailed note before the CPI numbers were released. Soterio argued that the on-chain data is generally bullish, and that it suggests that these prices could be a buying opportunity, adding, Bitcoin has entered the buy zone for dormancy flow, which has only flashed 5 times in Bitcoin's history, which all lead to incredible rallies. This indicator compares Bitcoin's market cap to the annual value of destruction. In layman's terms, it compares price to spending behavior. As the percentage of people spending their Bitcoin is so low, it shows the sentiment of investors unwilling to sell their Bitcoin at this price. As reported yesterday, Federal Reserve Chairman Jerome Powell said during his confirmation hearing that we probably remain in an era of very low interest rates. Should he be given another term, argues the founder and CEO of quantum economics Matti Greenspan, Powell will retain his position as the key figure at the helm of the great money printer. Rather than the statements, it is his boring presence on the stage, and his familiar monotonous message of the economy being able to handle the Omicron variant while gradually reducing quantitative easing and preparing to eventually raise interest rates, that helped alleviate investors' concerns and put them at ease. It's also important to keep in mind that the markets have declined a lot lately, so they are more than due for an upside correction, Greenspan wrote. Meanwhile, in China, the inflation came in lower than expected. China's annual inflation rate fell to 1.5% in December 2021 from a 15-month high of 2.3% a month earlier. The latest reading was less than the market consensus of 1.8%, per trading economics data. Reuters noted that, in the case of this country, the slower-than-expected December producer inflation made room for more monetary easing. Inflation jumped at its fastest pace in nearly 40 years last month, a 7% spike from a year earlier that is increasing household expenses, eating into wage gains and heaping pressure on President Joe Biden and the Fed to address what has become the biggest threat to the U.S. economy. Prices rose sharply in 2021 for cars, gas, food and furniture as part of a rapid recovery from the pandemic recession. Vast infusions of government aid and ultra-low interest rates helped spur demand for goods, while vaccinations gave people confidence to dine out and travel. According to AP News, as Americans ramped up spending, supply chains remained squeezed by shortages of workers and raw materials, and this magnified price pressures. The Labor Department reported that a measure of inflation that excludes volatile food and gas prices jumped 5.5% in December, also the highest in decades. Overall inflation rose 0.5% from November, down from 0.8% the previous month. Price gains could slow further as snags in supply chains ease, but most economists say inflation won't fall back to pre-pandemic levels anytime soon. U.S. inflation pressures show no sign of easing, said James Knightley, chief international economist at the financial services company ING. It hasn't been this high since the days of Thatcher and Reagan. We could be close to the peak, but the risk is that inflation stays higher for longer. High inflation isn't only a problem for the U.S. In the 19 European countries that used the euro currency, inflation rose 5% in December compared with a year earlier, the biggest increase on record. Inflation could ease as the Omicron wave fades, and as Americans shift more of their spending to services such as travel, eating out, and movie-going. That would reduce the demand for goods and help clear supply chains. But some higher prices, such as rents, could prove to be stickier. Rental costs, which have accelerated since summer, rose 0.4% in December, the third consecutive monthly increase. That's significant because housing costs make up 1/3 of the government's consumer price index. Powell told Congress that if it becomes necessary to fight high inflation more aggressively, the Federal Reserve is prepared to accelerate the interest rate hikes it plans to begin this year. The Fed's benchmark short-term rate, now pegged near zero, is expected to be bumped up at least 3 times this year. Rate increases would make borrowing for a home or car more expensive, and therefore help to cool off the economy. Some economists and members of Congress fear the Fed has acted too slowly to head off inflation, and that this could eventually force even sharper rate increases that could damage the economy. Republicans in Congress and even some liberal economists say Biden deserves at least some of the blame for high inflation, arguing that the financial rescue package he pushed through Congress last March added significant stimulus to an already strengthening economy.